Welcome, everyone, to another Bitcoin Deep Dive by MyCryptoParadise.
Glad to be diving into the charts today.
Yeah, and if you are listening right now, I really want to take a quick moment to just remind you that you are part of the Paradise family.
Absolutely.
We are navigating these chaotic and, frankly, sometimes terrifying crypto waters together. You know, you're never doing it alone.
That's the core of what we do.
Exactly. And our mission today is an incredibly important one. We are going to be breaking down a really exclusive math class level analysis from our very own Paradise team trader, Simon.
It's a fantastic breakdown.
It really is. We are diving deep into his latest Saturday video where he meticulously analyzes the current 2026 market structures.
And it is a critical analysis because Simon isn't getting distracted by the immediate noise, or the intraday volatility. He is looking at the fundamental architecture of the market itself.
Right, mapping out where the major capital is actually flowing while the rest of the market is just completely distracted by the headlines.
Yeah, they're chasing the shiny objects.
Always. And we are definitely going to cover the critical tactical price targets he laid out in that video, including the very real potential for a major structural crash down to the $44,000 level.
Which is a heavy target to consider.
It is, but the real mission of this deep dive today is psychological. We are going to completely deconstruct the professional systematic mindset versus the gambling mindset.
The behavioral science aspect of trading.
Exactly that. We want to explore why human biases cause the vast majority of people to lose their money in the long run, even if they happen to get, lucky on a few trades in the short term.
Because short-term luck is just a slow death sentence if you don't have a system.
100%. And we are going to reveal the exact tactics the smart money uses to capitalize on that retail panic.
Okay, let's unpack this. Because right now, looking at the lower time frames, the market looks like an absolute bloodbath to a lot of casual observers.
If we connect this to the bigger picture, the widespread panic makes perfect sense from a purely emotional standpoint.
Right. But as Simon points out in the video, when you force yourself to take a breath, slow down, and zoom out to the weekly chart, that terrifying chaos completely fades.
It really does just vanish.
You start to see a very clear, very deliberate macro structure forming. And importantly, it is a structure we have seen play out before.
The 2022 ghost.
Yes.
Simon laid out this factual, undeniable parallel. The current 2026 market structure is aggressively mirroring the 2022 bearish cycle.
He brought the receipts for it, too.
He did. He mapped out how the market recently topped out around the $124,000 to $125,000 mark.
Yeah.
And that peak actually overshot his crucial $121,000 level, just a tiny bit.
Creating a higher high.
Right, which is exactly what happened during the previous cycle highs before the trap snapped shut. And then, right on cue with that historical fractal, the major crash began.
And the visual parallel on the weekly charts is striking. You can clearly identify that initial massive distribution phase where the smart money offloads their bags.
Onto retail.
Right onto retail. Followed by the definitive top, and then the inevitable shift where the bears take absolute control of the trend. To help visualize this, Simon uses an analogy that I think is absolutely vital for anyone trying to survive long-term in this market.
The breathing organism analogy.
Yes. He describes the market as a living, breathing organism.
It is a great framework because an organism cannot just endlessly inhale and it certainly cannot endlessly exhale. There has to be a biological rhythm to the movement.
And in market terminology, the exhale is the bearish impulsive crash.
Okay, break that down for us.
So the market is expelling energy, it's pushing the price down heavily, flushing out the over-leveraged long positions. That's the exhale.
Got it.
The inhale is the bullish pullback. That is the market gathering its breath, reclaiming some liquidity, and rebalancing before the next major move.
Which makes a lot of sense when you look at the charts.
Exactly. When you understand this natural rhythm, it completely shifts your psychological baseline. You stop viewing a normal, structurally necessary pullback, an inhale, as the definitive start of some massive new macro bull run.
Because you expect the organism to breathe.
You expect it.
Right.
And when you expect it, you do not let the short-term green candles trick you into abandoning your broader bearish thesis.
And maintaining that clinical detachment is exactly what separates the Paradise team from the broader retail herd. Because the herd, driven by deeply ingrained human biases like loss aversion and confirmation bias, they just fall into the gambler's trap every single cycle.
It's like clockwork.
It really is. Simon highlighted this tragic behavioral loop. The retail traders see that inhale, that minor bullish pullback on a lower time frame, and their fear of missing out just takes over completely.
They want the pain to end.
Right. They're so desperate for the pain of the bear market to end that they project their hopes onto the chart. So they end up longing the absolute top of the pullback because they are thoroughly convinced they are catching the absolute bottom of a new bull trend.
What's fascinating here is the underlying behavioral science driving those decisions.
The brain chemistry of it all.
Precisely. The gambler's mindset is entirely hijacked by emotion, adrenaline, and dopamine. They are fundamentally reacting to the herd, seeking psychological safety in numbers.
If everyone on Twitter is buying, it must be safe.
That's their logic. They want the instant gratification of getting rich quick. So they smash the market buy button with high leverage right at local resistance. They assume that because everyone on social media is suddenly bullish again, the bottom must be in.
And then the market organism exhales again.
And the broader structural downtrend resumes,
leaving them completely trapped underwater. But the cycle doesn't end there, right? Simon talks about the second phase of this psychological meltdown, which is arguably even more destructive than the initial bad trade.
Much more destructive. The second phase is where accounts get entirely wiped out. It is the revenge trading phase.
Ooh, revenge trading.
Driven by sheer frustration, anger at their unmanaged losses, and a desperate need to make their money back immediately. These traders switch their biases completely. Total whiplash. They swing from extreme greed to extreme fear. They heavily short the market, again using irresponsible leverage right as the market is actually bottoming out and preparing for its next structural inhale.
So they are perpetually out of sync with the organism.
Because they are trading their raw emotions rather than trading the objective chart structure.
It is a brutal cycle to witness, but it reinforces exactly why we at MyCryptoParadise hammer home a fundamentally different ethos. We are not treating the crypto market like a casino.
Never.
The true professional goal is capital preservation. It is about protecting the portfolio at all costs and executing consistent, systematic growth over a multi-year time horizon.
It's a marathon.
Exactly. Simon brought up a crucial non-negotiable rule in his analysis. He said it is significantly better to miss a potentially profitable trade entirely than to risk your core capital on a low probability setup.
Survival in the market is the ultimate prerequisite for success.
You can't play if you have no chips.
Right. If you decimate your capital playing the hero on a low probability gamble during a choppy, bearish exhale, you simply will not have the ammunition available to take the high probability setups when they finally present themselves.
The professionals aren't trading for the thrill or the adrenaline rush. They are mechanically executing a tested system.
Which brings us to how those professionals, the smart money and the institutional whales, are actually positioning themselves right now while the herd is panicking.
Simon pointed out that the fear and greed index has touched 20 recently. That's signaling extreme fear across the broader market sentiment.
And in the professional trading ecosystem, extreme fear in the herd is a highly actionable signal.
How so?
Well, it indicates that the emotional, undercapitalized traders are capitulating and liquidating their positions. When the herd is utterly terrified and panic selling, a professional, systematic trader is actively looking to position themselves on the exact opposite side of that liquidity flow.
Simon backed this up with hard data, too. He pulled up the divergence between the cumulative volume delta and the order book suite.
That is some serious tape reading.
It is, and it's the kind of advanced tape reading that really separates the pros from the amateurs. For the listeners who might not monitor those specific tools daily, let's break down the mechanics of what those two contrasting metrics were actually showing us on the 2026 charts.
This is where we get to peek behind the curtain at how institutional capital operates.
The real smart money.
Exactly. The cumulative volume delta, or CVD, tracks aggressive market orders. It shows us what participants are doing at the current market price right this second.
Right.
Right now, that delta is heavily negative. That confirms that the retail traders, the frustrated gamblers we just discussed, are angrily smashing the sell button at market price, often unwinding leveraged long positions at a major loss.
They are aggressively dumping liquidity into the market.
But the order book suite was showing an entirely different narrative playing out simultaneously.
While retail is aggressively market selling, the order book suite, which tracks passive limit orders, shows something completely different.
It shows that the smart money, the entities holding anywhere from 100 to 1,000 Bitcoin, are quietly absorbing that selling pressure.
And we know this because of the basic mechanics of institutional liquidity.
Right. If you are an institutional whale, you cannot simply execute a market buy order for hundreds of millions of dollars.
It just doesn't work.
If you do, you instantly consume all the available liquidity in the order book. The price skyrockets before your massive order is even partially filled, and you suffer catastrophic slippage. It is mathematically unviable.
Wait, I want to push back on this for a second. If we can clearly see the smart money building a net of limit orders and absorbing all this retail panic at a discount, why shouldn't our listeners just front-run them?
Ah, the classic front-running trap.
Right. If the whales are actively buying the dip right now, why are we sitting on our hands and preaching capital preservation instead of aggressively buying alongside them?
That is a very common trap, and it comes back to the difference between institutional time horizons and retail leverage.
Explain that difference.
Whales scale into positions over weeks or months, and they have the capital depth to withstand a further 20% drop without getting liquidated.
A retail trader using leverage does not have that luxury.
Exactly. If you blindly jump in just because you see limit orders forming, you can easily get caught in a localized flush that liquidates your specific account before the broader reversal happens.
This happens all the time.
All the time. That is why Simon doesn't just blindly buy when he sees whale accumulation. He waits for confirmation.
Here's where it gets really interesting, though, because that transitions perfectly into Simon's sniper approach. He knows the accumulation is happening, but he is waiting in the weeds for the absolute perfect risk-to-reward ratio to align with his specific system.
That patience is the hallmark of the Paradise Team methodology.
We preach it daily.
Simon emphasizes that as professional traders, we are never dealing in absolute certainties. Certainty is a dangerous illusion sold to amateur gamblers.
We deal exclusively in probabilities.
Is the statistical likelihood of this specific setup playing out 20%? 60%? 70%.
You have to know the math.
Calculating those exact probability points, waiting for the alignment of multiple technical factors, and sizing your risk accordingly. That is the fundamental difference between throwing darts blindfolded and executing a professional, durable trading strategy.
And Simon didn't just speak in abstract probabilities. He gave us the exact factual tactical levels he is monitoring right now on the charts to calculate those probabilities. Let's lay them out.
Let's do it.
First, he noted a very strong wall of resistance, sitting right between $70,000 and $72,000. We saw a fake out above that level previously, but the bears heavily defended it. And it has reestablished itself as a major structural ceiling.
It's a massive wall.
Then, on the downside, there is crucial support hovering right around $67,000, with the potential to dip down to a wick at $66,900.
Right.
But the really ominous target he highlighted was a massive, concentrated cluster of long liquidations, waiting down at $65,000. He stated that, based on the current market rhythm and the gravitational pull of that liquidity, we could see the price hit that $65,000 liquidation cluster in about 2 weeks.
He is projecting those specific levels through very precise, highly bearish technical indicators that are currently flashing across multiple time frames.
The WXY pattern.
Right. Yes. For instance, he broke down the double three, or a WXY corrective pattern we're seeing on the medium time frames.
That pattern absolutely decimates retail traders who try to trade the chop.
Yeah.
Let's get into the mechanics of why that specific pattern is so toxic for the gambler mindset.
A WXY pattern is essentially a complex sideways to downward corrective structure. It often subdivides into double zigzags.
Sounds messy.
It is. From a psychological standpoint, it is designed to maximize emotional exhaustion.
Break down the waves.
The initial W wave drops, causing panic. Then the X wave pulls back up just enough to convince retail traders that the bottom is in, trapping late breakout buyers.
The false hope wave.
Exactly. Finally, the Y wave rolls over and violently breaks the previous lows, completely destroying the spirit and the capital of anyone who bought the X wave.
Brutal.
The key takeaway for our listeners is that this entire WXY pattern is a corrective mode wave. It is an inhale that moves against the broader, heavier trend. And right now, as Simon established with the 2022 fractal, that broader impulse is pointing aggressively down.
And if the WXY pattern wasn't enough of a warning sign, Simon also pointed out the critical 1.272 Fibonacci retracement level. The way algorithmic trading bots target that specific extension to hunt liquidity is just brutal.
It is a classic trap. Simon showed exactly how he derives that 1.272 level by connecting the absolute bottom of the final dump with the peak of the first impulsive relief wave.
So how do the bots use that?
Algorithmic traders and institutional bots know that retail traders will place their stop losses just above the previous structural highs. The 1.272 extension is mathematically programmed to overshoot that previous high, just enough to trigger all those stop losses, grab that resting liquidity, and then immediately reverse.
You saw this in 2022.
Back in 2022, the price pushed up to that exact Fibonacci extension. The retail herd screamed that the bull market was officially back, and then the algorithm snapped the trap shut, liquidating everyone who bought the breakout.
And we are seeing that identical structure pushing up against that exact same Fibonacci extension right now in 2026.
The exact same structure.
Simon also spotted a massive shooting star rejection on the weekly chart, and we both know exactly what that means in this context. A brutal rejection at the local highs where retail got left holding the bag yet again.
The shooting star perfectly visualizes that failed breakout at the 1.272 Fibonacci level. The bulls were incredibly confident early in the week. They pushed the price up, creating the long upper wick.
But the bears were waiting.
But before the weekly candle could officially close, the institutional bears stepped in with overwhelming volume. They absorbed all that buying pressure using their limit orders and slammed the price all the way back down.
So it's a definitive reversal signal.
It is, confirming that the bearish exhale is about to begin in earnest.
So what does this all mean? When you stack all of these confluences up, the WXY complex corrective pattern, grinding down retail psychology, the algorithmic rejection at the 1.272 Fibonacci liquidity trap, the definitive shooting star weekly close, and that massive glowing cluster of retail liquidations waiting like a magnet down at $65,000.
It's a perfect storm.
You can clearly see why Simon and the Paradise team are not rushing in to long this market out of FOMO. The probabilities are heavily skewed against the bulls.
They are heavily skewed toward a continuation of the downside macro structure.
Right.
If the 2022 fractal completes its rhyme, we are looking at a localized flush to the $65,000 liquidations, with the very real potential of structural breakdown pushing all the way toward that $44,000 macro target over the coming months.
Let's bring this all together for everyone listening today. The core lesson of this deep dive is profound and highly actionable. The market is rhyming with the ghost of 2022. The retail herds are out there right now, completely trapped by their own biological human biases. They are gambling their capital away by panic selling the bottoms and FOMO buying the local tops.
It's a vicious cycle.
But here inside MyCryptoParadise, the Paradise team is acting as the sniper. We are patiently waiting in the wings. We are relentlessly protecting our capital above all else. We are tracking the quiet, passive limit orders of the whales, and we are trusting a proven, systematic approach.
Because surviving the chop and preserving your portfolio is the only way you get to thrive when the real high-probability macro shifts finally occur. To truly anchor that professional mindset, I want to read Simon's personal trading mantra. This is exactly how he ends his market analysis, and I want you to really listen to these words and let them become your baseline.
Go ahead.
Simon says, "I think in probabilities, not emotions, and I remain calm and disciplined in every market condition. I follow my trading system with precision and patience, waiting only for high probability setups. I respect risk management and protect my capital above all else. Losses are feedback that sharpen my strategy, and wins are the result of discipline and execution. I detach from outcomes."
Detaching from outcomes is the ultimate cheat code. It completely removes your ego from the chart and allows you to trade the probabilities instead of your pride.
This raises an important question for you, the listener, based on everything we have covered today regarding whale accumulation and retail psychology.
What's the question?
We know that institutional smart money relies entirely on the emotional panic of the retail herd to fill their massive limit orders without suffering slippage. They literally monetize retail fear.
Right.
So, what happens to the entire market structure if one day the retail herd stops panicking? If a critical mass of traders adopted the Paradise team mindset, detached from their emotions, and only traded systematic probabilities, could the whale's accumulative system even survive without our fear to feed it?
That is an incredible thought exercise. If we start providing the chaotic liquidity, the smart money has to completely rewrite their playbook. That is the exact shift in perspective that takes you from being the prey to being the sniper. Thank you all for joining us on this MyCryptoParadise deep dive. Remember, you are a valued part of this family. We are here to help you navigate these complex markets with clarity and discipline. Stay safe out there, follow the system, and above all else, always protect your capital. We will see you on the next deep dive.